Good morning and welcome to Edison Think Tank. The title of today's call is The Search for Yield, What's Happening in Credit Markets. As we all know, we're in a world where banks are charging customers to hold their deposits. And as a consequence, investors are being forced to look at alternative strategies in order to preserve their income stream. So I thought this would be a good time to get CVC Credit Partners European Opportunities Limited on a call to discuss their listed investment fund, which has a gross yield of almost 7.5% and is supported by a portfolio of companies which are generating almost 500 million euros in EBITDA. So I'm delighted to be joined by Pieter Staelens, who's the MD and Portfolio Manager at CVC. Prior to joining CVC, he worked at Henderson Investors in London, where he was involved in various high-yield portfolio strategies and also a credit long-short portfolio. I'm also joined from Edison by Alastair George. Alastair is strategist at Edison. He also has run long-short strategies at Lehman Brothers and was also, prior to that, a strategist at Goldman Sachs. So the presentation is going to last roughly about 20 minutes or so, and then we'll move to Q&A. If you wish to ask a question, please click on the participants button and then raise a hand, and we will go through the questions one by one. In the meantime, you'll all be on mute for the time being. So maybe if I could start, Alastair, by asking you, in the past, credit markets have been very much a good lead indicator for what's going to happen in equities. Given that we've seen and are seeing so much central bank involvement and distortion of the yield curve, do you think that is still the case?
I think when we look back to the previous cycle leading up to the financial crisis, one of the things to bear in mind is that the credit and the banking system was central to the problem as such. So the undercapitalization of the banking system through 2007, 2008 led to stress in the interbank markets, and I think equity investors were a little bit slow to pick up on that. But credit was at the core of the issue. In this cycle, that's not the case. It's a pandemic, which is the issue, rather than undercapitalization of credit markets per se. So while we have seen stress in credit markets from a liquidity perspective during March, the actions of it's not been central to developments. What's been central to developments has been the evolution of the pandemic. So I think one has to look certainly for evidence of stress or distress in credit markets, but also the primary factor this time around is the evolution of the pandemic, and in particular, the economic impact of government interventions to control infections.
That's interesting. Thanks, Alastair. Pieter, would you have anything to that?
Yes, I would say overall credit markets have continued to function pretty well. There was a period for about 2-3 weeks towards the end of March where liquidity was disappearing, but overall credit markets have dealt pretty well with the recent pandemic. Of course, that's been helped by what central banks have been doing. The Fed has announced that they have started buying fallen angels. The ECB has pumped additional money in the system. So, yeah, I would say overall credit markets have performed reasonably well during this time.
Okay, but a question to both of you: do you think that credit markets are telling us anything in particular right now, as we're coming through an election period, we're into the fourth quarter? Do you think they're giving us any sort of clues or indications as to what's happening? Or what's about to happen, I should say.
Pieter, would you like to take that?
Yeah, of course. So I would say over the last couple of days and weeks, credit markets have outperformed equities. The the weakness we've seen in equities over the last couple of days and weeks has translated marginally into credit. But in general, credit feels fairly relaxed about the elections. I think it's started to look more and more likely that Biden is going to win, which means additional stimulus for the US economy. So we should continue to see earnings bounce back. Of course, we keep a close eye on what's happening beyond the elections. There's a big spike in infections in Europe. Increasingly talks of additional lockdown measures, but as long as these lockdown measures go paired with stimulus measures, we've seen in the UK an additional stimulus package, then credit markets are willing to look through that near-term weakness. So overall, we remain cautiously optimistic on the outlook. But of course, there will be some volatility going into elections and into potential additional lockdowns.
Okay, thank you very much, Peter. Yeah, and Alastair, so a reasonably encouraging outlook. Alastair, would you share that view?
I think I share Peter's view that credit markets have been well behaved going into the autumn. I think I'd also add that global equities are relative to credit in a first loss position as the more junior securities in the global capital structure, and have possibly suffered a little bit more from the rising infections in Europe. Although that said, and this is probably relevant to both equities and credit, from an consensus earnings forecast perspective, there's actually been a gradual recovery of earnings expectations for 2020 over the course of the summer. The upward trend has moderated more recently, but the rising infection rates, which of course very well known, have not yet translated into any reduction in corporate earnings forecasts, except in very specific cases.
Okay. So again, a reasonably encouraging and optimistic outlook into the fourth quarter.
I think, Bill, there is some uncertainty, and the question for me from an equity perspective, and possibly this will sort of overlap with the riskier end of credit, but Peter will be able to comment on that, is looking forward, investors have few alternatives. And going back to your original question, one of the impacts of the pandemic has been to crush government yield curves all the way up. We were only a year ago expecting the Fed to be on a rising trajectory of policy rates. So that search for yield is very relevant at this point. But I'm just perhaps compared to 4 weeks ago, I'm just a little bit nervous for equity space, that there could be a little bit of a hiccup in terms of confidence between now and when a vaccine becomes more widely available in Q1, Q2 of next year.
Okay, interesting. Thanks very much. So we've seen recently an explosion in M&A in the US. A lot of that is probably because many deals were put on ice. We're seeing and they've come back and been brought back live. We're also seeing SPACs. So are we about to see a further wave of capital raising? And is that going to be evident in credit markets as companies seek to raise fresh pools of capital?
Yeah, we're definitely seeing.
Peter, I'd ask you.
Yes, we're definitely seeing a lot more M&A activity. As you said earlier, back in March, April, everything was put on hold, and these M&A processes have started to pick up again during and after the summer. We're also seeing that private equity funds are sitting on record amounts of dry powder, and they are looking to deploy this. So we're seeing an increased amount of public to privates, also large corporates who are selling non-core divisions to effectively pay for the cost of the pandemic. So we're seeing a lot more M&A activity post the summer now. And that should translate in additional issuance of debt, because a lot of this debt, especially when it's through private equity, will these transactions need to be financed with debt. So we're seeing a lot more supply of debt, and we expect that to continue into the first half of 2021.
Okay. We've heard of a funding gap. There are certain, I know Edison has written on this. Is that something that you potentially see, that that there might be sufficient demand for certain pockets of credit, or do you see it the other way around?
Yeah, we believe there's definitely sufficient demand. As you said, the world is starved of yields. I saw a recent statistic which I think about 20 or 25% of all global fixed income is negative yielding, and about 80% yields less than 2% now. So people are looking for yields, and we're seeing inflows into the asset class. I think US high yield has had record inflows this year. So there is definitely demand for higher yielding debt out there, and the supply is coming as well.
Okay, interesting, Pieter. Yeah, thanks. Do you have any comments on that end?
Sorry, I beg your pardon, Bill.
Sorry, would you have any comments on the supply and demand for credit and funding in general across not just credit but also equities?
Yeah, I mean, I think what's going on is there was a hiatus in Q1, Q2 when no one really knew how things would unfold. Credit markets have clearly reopened. We've also seen a run of equity issuance as well. It just remains to be seen how much of how severe the lockdowns will be in Europe in particular from an equity perspective. And I'd also be intrigued to hear what's been happening with default rates in credit markets as well from Pieter.
Yeah,
Pieter.
default rates have been pretty low actually. Back in March, April, we saw a lot of strategists forecasting default rates going to 8-10%. In European sub-investment grade markets, we're at around 2.5% over the last 12 months. So it's still fairly low. It's rising, but it's not really spiking rapidly. So we would expect default rates maybe to settle around 4% by year end, and maybe they'll go up a little bit more in the beginning of Q1, depending on how the pandemic plays out, of course. But default rates have been lower, mainly because of the government's intervention. Without all the furlough schemes and the VAT deferrals and all these things, I believe default rates would have been a lot higher.
Okay, that's great, Pieter. Thank you. So I guess the other thing, Pieter, is has been a lot of, and there was increasing talk now, and if we do get Biden win, but you're seeing at the coalface right now, are you seeing an increase in prevalence of that type of funding?
Sorry, could you repeat the question? You were breaking up a little bit.
The issuance of green bonds and ESG bonds. Is that something that you are seeing, and are you expecting to see more of that? And how are they being priced at the moment? Are they attractively priced for you?
Yes, the green bonds is at the moment still mainly an investment grade phenomenon. So it's not really a market we participate in a lot. However, we have seen some green bonds come to our market as well. Another phenomenon that we've seen is where the interest rate is linked to certain ESG KPIs. So if a company improves their ESG KPIs, there may be a step down in the interest they're paying. So there's definitely a lot more focus from credit markets on ESG. And look, we've probably trailed the equity markets a little bit because we don't have the same ability to influence management's decision taking. However, there's a lot more that is happening in the credit world on the ESG side, and green bonds is only a small part of that, really.
Yeah. Yeah, and I presume if we get a Biden win, that we're probably going to see more of a focus on that end of the spectrum.
Yes, I would definitely expect so. And look, whether Biden or Trump wins, I think the importance of ESG will continue over the next 4 and 10 years. So this is not a phenomenon that is going to stop overnight, even if Trump wins.
Yeah, yeah. No, you're right. Yeah. So, and Pieter, the other sort of aspect that we've seen the rise of the renminbi in recent months. We're seeing more talk and more focus on buying yield in Asia. Now, while specifically that's not your field, is that something that you're coming across increasingly, or is it very much at the margin, do you think?
It is at the margin. There are a couple of specialized EM credit shops. It's not something we really focus on. So it's there are some specialized investors in that area, and I'm sure they're very good at it, but it's not something we focus on.
Yeah, yeah. Okay. So, Alastair, I'm just wondering, just in the broader scheme of things, what opportunities you see in the world right now, please?
Well, just going back to my earlier sort of comments, for the medium term, investors are actually faced with very few opportunities to earn returns above the rate of inflation in the lower risk asset classes such as government bonds or investment grade. I think more than at any other time during the past 10 years, because this has been a consistent theme, this search for yield. As policy rates have stayed very low and government bond yields have stayed very low. And I think it's, from a strategy perspective, speaking more broadly than just credit, investors still need to be prepared to take some risk to get expected returns in the 5 to 10% range, whether that's within equity markets or within the high risk end of the credit spectrum. But I also think there's a substantial degree of uncertainty remaining in terms of the evolution of the pandemic. There's been some very accelerated structural changes in terms of the shift to online and digital, which are probably going to stick. And we don't know just how far they're going to push because we don't know for how long we'll be in this regime, whether that's a lockdown kind of regime or a stop-start kind of lockdown kind of regime. But there will be corporates which are attractively valued in that environment and generating substantial amounts of cash flow, which will represent investments likely to return significantly ahead of the low risk investments such as government bonds and cash. And the question is, you do have to be selective in terms of the sectors and the securities. But that's the medium term view. But as I mentioned earlier in the call, with this rapid shift amongst European governments towards imposing fire break lockdowns, if you will, then I think there could be in the very short term a little bit of volatility immediately ahead.
Okay. Okay, Alastair, you're pretty consistent in that view that it's going to remain volatile over that period. So, Pieter, finally, for you, what opportunities do you see right now?
Yeah, we continue to see a lot of opportunities. As you said earlier, we've got a portfolio of some large companies and the yield on the portfolio is north of 7%, and we continue to see opportunities both in the primary and in the secondary market. So there are some assets that are still mispriced. There are some assets that are going to struggle for a while the pandemic is ongoing. But as long as they have strong liquidity, these are businesses that should eventually bounce back once there is a vaccine. So yeah, and we are invested in the most senior parts of the capital structure, as Alastair referred to earlier. So we feel pretty good about the outlook. There are some opportunities where we can get some capital upside still, and on top of that, we've got a decent income on the portfolio. So we're feeling good about the near-term outlook.
Okay, excellent. That sounds very encouraging, Pieter. Okay, I think at this point, I think we'll pause, and I'd like to invite any questions from the participants, please. If you wouldn't mind just clicking on the participants button and then raise a hand, and we'll go through the questions. So over to the audience, please. John, do you have that?
Yes, if Simon could unmute himself, I've allowed him to speak.
Hi there, thank you. That was very interesting. So over the medium term, do you see bonds outperforming the equity markets?
Well, we've seen some outperformance over the last couple of weeks. The weakness that we saw in the equity markets hasn't really translated into the credit markets, and we're seeing a lot of demand for credits. And as long as that demand stays there, we would expect credit markets to remain fairly stable, actually. So back in March, there was a big sell-off in the credit markets, but there was effectively a wall of money that invested in the markets because they saw this as an opportunity. They were willing to look through the pandemic. So, and I would expect that credit investors will continue to do the same going forward. So they will look through the pandemic. There will be a vaccine at some points. It may not be this year, maybe next year. But eventually, if leverage spikes because the economy is shut down, that is not something that will keep credit investors awake as long as these businesses have sufficient liquidity and everything. So default rates will continue to go up a little bit, but I don't expect a material spike in default rates. And as long as these conditions prevail, credit markets should continue to remain fairly robust.
Thank you. Thank you.
Rory, if you could unmute yourself, please.
Thanks, I got the prompt, yes. You guys, thanks for the presentation. You referred to default rates, not going up to the extremes people had seen or expected. Are there sectors where default rates are under more pressure?
Yeah, there's definitely some sectors where default rates are under pressure, and it's the sectors you would expect. The restaurant sector, the hospitality sector, the airline space, so anything that is directly impacted by COVID, and all of these bonds and loans still trade at the discount to par. So it is our work really to shift through all these credits and see which ones actually have a long-term sustainable future. I mean, we've invested in some names that should benefit materially from the staycation team. So not all travel and leisure names will be impacted by the same along the same lines. So there will be opportunities, but yes, we're seeing most of the distress in areas that have been directly impacted by COVID.
Thank you. Oh, sorry.
Hello?
Hello?
Hello, can you hear
Hi,
me?
Joe. Yeah, we can hear you.
Yeah, there's just one or two questions. The first question is it's the actual word pandemic, which has been used to describe this viral outbreak. Has that any legal significance in debt documentation?
There's no debt documentation that, or at least not that I'm aware of, that has the word pandemic in it. I think right now the credit markets are looking through the spike in leverage because businesses have been shut for a certain number of months. As long as they have sufficient liquidity, leverage will come down again. And some businesses have raised additional liquidity in the credit markets. Some businesses have raised equity, either through public markets or where the private equity owner has injected additional liquidity in the business. So the word pandemic doesn't really show up in credit documents, and it's something companies will have to learn to live with it. And as long as they have sufficient liquidity and they don't breach covenants, then they will get through this at some point.
Okay, so there's no legal import of the name of the award. The second thing was in terms of the sectors that you're, for example, your fund is invested in. What would be the biggest sector weighting in terms of a corporate yield portfolio that you have?
So right now we've got a dual strategy really. So we've got part of the strategy which is invested more in performing credits, and there we like names that have very little impact from the pandemic. There's sort of the TMT space, the software space, healthcare. So we like spaces where there's little impact. And then we have also a more opportunistic part of the portfolio where we invest in assets that trade at a discount, where we will look at names that have been impacted, and we need to see if the return that we get on these names actually makes sense. And I mentioned earlier that the staycation team is one we've picked up on, and it's and that has played out reasonably well. So we take slightly different approach depending on what returns we can get on these names.
Okay, so your sector bias would be TMT and software present.
Yes, that's right. Yes.
Thank you.
Thank you, Joe. So the question.
You could unmute yourself.
Hi, hello. Thanks very much for the webcast. Question one: how liquid is your portfolio? Where can we see any granularity on your portfolio? Do you have any type of fact sheets, etc.? I mean, the question was already asked on the sector. It would be nice to see the concentration, for example, and more specific from that point of view. And finally, is your fund accessible through UCITS?
So on liquidity, there is liquidity has actually been fine throughout 2020, with maybe the exception of around 2 weeks around mid March. So the market is fairly liquid. And again, if you look at the companies we invest in, I think Bill mentioned earlier, the average EBITDA of our portfolio company is 500 million. So these are large and liquid capital structures. They may have loans outstanding, bonds outstanding in Europe and the US. So we're not really concerned about liquidity. I think the largest position size is around 3.5%. So it is a well-diversified pool of assets that we have. And in the second to your second question, no, I think there's still a problem that with UCITS funds and having leveraged loans in there. So that's a wider industry problem. So I don't believe the fund is available in the UCITS structure right now.
Okay.
So I have another question from someone asking about the sector composition of the fund. I mean, you've touched on that. Is there a difference between, you mentioned there's two components to the fund. Is there a difference in the sector composition for each of those two components?
Yes, there would be. As I said, we have a part of the portfolio which is performing, i.e. we would get about between 4 and 5% return on these assets, which is sufficient to cover the dividends we're paying. And then there's a more opportunistic part of the portfolio. And as you can imagine, the more opportunistic part of the portfolio, we need higher returns, which means the debt would trade at a discount. And there are not a lot of sort of TMT or software assets that trade at a material discount to par. So these are assets where there have been some issues, but we spend a lot of time and a lot of analytical resources on analyzing these companies inside out, and that's really the core strength of CVC. We analyze corporates and we kick the tires until we feel comfortable we can invest in something, and then we should see some higher return on that part of the portfolio.
Okay, excellent. Okay, thank you. So are there any further questions?
I believe there's one more in the Q&A. I muted Danielle early, so I think she's finished her question in the Q&A.
Oh, I think it's just what the size of the fund is, Peter.
The size of the listed fund is, well, you can see the market cap. I don't have it here in front of me, but the overall fund is north of 500 million.
Yeah. Okay, and in terms of the discount mechanism, do you have any particular strategies around that you'd like to discuss, Peter?
Do you mean the assets we buy at discount, or? Yeah. So there are a number of assets in the loan and in the bond market that trade at the discount to par that yields 8, 10, 12%, and we analyze most of these. We've got a large team of analysts that would pick up on all these names. When something sells off, we will have a look at it, and we may not invest initially because it doesn't hit our return targets, or we're not certain about the outlook. So we keep on monitoring these names then, and maybe at some point we would invest in it. So there's no real strategy. We just monitor the markets, and we continuously look for opportunities.
Okay, very good. Alastair, I don't know if you've any questions for Peter.
Not at this stage, Bill. I've learned a lot actually, so no, I'm happy. Thank you.
Okay.
We have another question from Joe.
Yeah.
Okay, just it's another two questions, gentlemen. One, in terms of the portfolio, what's the duration of it? Number one, and number two, both of you have expressed an investment view predicated on a vaccine company soon, which would be unprecedented. So, in the event that we still don't have any medical solution for this supposed pandemic within the next 2 years, does that change your investment view significantly, or would it change your portfolio significantly?
Yeah, well, I think if there's no vaccine 2 years from now, I think a lot of people will have to adjust their investment strategy, and we will have to adjust our investment strategy as well. And look, when we look at these businesses, we assume an extreme downside scenario where, like when we invest in businesses that are impacted by the pandemic, then we would model an extreme downside scenario, which I think right now would be the entire 2021 without the vaccine. But look, there is a lot of progress being made, and maybe we don't need a vaccine if we get some effective testing. Let's say if you go to the airport and you get a test result in a couple of minutes, whether or not you're positive. So that should be positive for the travel and leisure industry. So look, our investment thesis is not built around a vaccine being available overnight. We look at these businesses and say, look, how long or how much liquidity do they have? How much runway do they have? Assuming no vaccine for another 12 months or so. So that's really the approach we take. We're credit investors. We're not equity investors. There's not a lot of upside for us. So we always look at our downside first, and then we can, well, if there's a vaccine earlier, then that's only upside. But we analyze our downside first. And sorry, I've forgotten your first question now.
Duration.
Yes. So the majority of our investments are leveraged loans, which are linked to LIBOR. So there's the duration of the portfolio is actually very low. So there's hardly any duration.
Okay. Thank you.